As the shadows of economic uncertainty loom, JP Morgan, the financial giant, has released a chilling prediction. A recession is on the horizon. Join us as we delve into the data and unravel the mysterious forces driving this potential catastrophe. Will the economy spiral out of control, or will the unexpected developments lead to a miraculous recovery? Watch now to find out. The CEO of JP Morgan Chase, Jamie Dimon, recently raised alarm bells over the potential of the economy sliding into a recession once more. During an interview at the World Economic Forum in Davos, Switzerland, he spoke candidly about the state of interest rates and the possibility of an upcoming recession. In the interview, Dimon stated,
I actually think rates will probably go higher than 5%. That's my own view because I think there's a lot of underlying inflation which won't go away so quick.
He went on to express his belief that if the US does enter a recession, even a mild one, interest rates will rise to 6%. This is a concerning prediction for the economy and the future of interest rates. It's important to note that this is not the first time that Jamie Dimon has spoken about the potential of an upcoming recession, and his insights and predictions are always worth paying attention to. JP Morgan is now forecasting a mild recession as their central case for 2023, which could spell trouble for investment markets. It's important to consider the potential impact of a recession on the economy as a whole and the potential ripple effects it could have on industries and individuals. It's always best to be prepared for the worst and hope for the best in these uncertain times. Despite the Federal Reserve's efforts to curb inflation by raising interest rates to the highest level in 15 years, Dimon believes the recent pause in inflation is not due to systemic changes. The anticipated terminal rate, or the point at which officials expect to end the rate hikes, was set at 5.1% at its December meeting. However, Dimon's comments suggest that it may require more action from the Federal Reserve in order to truly address the issue, highlighting the ongoing challenges the Fed and other central banks may face in trying to manage inflation in coming months. It's important to understand the role that inflation plays in the economy and how it can impact the interest rates and overall economic stability. Dimon stated that the recent easing of inflation is due to temporary factors such as a pullback in oil prices and a slowdown in China caused by the COVID pandemic. He went on to say that China isn't going to be deflationary anymore. These are important factors to consider when analyzing the state of the economy and understanding the potential future developments. If Dimon's comments about inflation turn out to be correct, the Federal Reserve may have to tighten their interest rate policy even further. This could have a negative impact on businesses and increase the risk of a more severe recession. It's important to keep an eye on these developments and to stay informed about potential changes in the economy in order to be prepared for any potential challenges that may arise. However, Jamie's predictions are not the only ones to spook us. JP Morgan itself recently released a market outlook for 2023, where we can find more detailed predictions. According to the market outlook for 2023, the global economy is projected to expand at a sluggish pace of around 1.6% in 2023 as financial conditions tighten, the winter exacerbates China's COVID policy, and Europe's natural gas problems persist. This suggests that the global economy may face significant challenges in the coming year as financial conditions become increasingly tight, and external factors such as the winter, COVID, and natural gas problems in Europe could weigh on growth. The market outlook also provides a breakdown of growth forecasts for different regions. According to the report, global GDP growth in 2023 is forecast to climb 1.6%. Developed market growth is forecast at 0.8%. US growth is forecast at 1%. Euro area growth is projected to come in at 0.2%. China's economy is forecast to grow 4%, and emerging market growth is forecast at 2.0% in 2023. These numbers indicate a significant difference in growth among different regions, with the Euro area potentially facing a mild recession and the US sliding into recession by the end of 2023. JP Morgan also highlights the potential impact of rising borrowing costs on the housing market. As the cost of borrowing increases, it can become more difficult for individuals and families to afford to purchase a home, which can negatively impact the housing market. Additionally, the report mentions that the sharp climb in the US dollar is likely weighing on US corporate profit margins. As the dollar increases in value, it can make exports more expensive for United States companies and decrease their profit margins. The outlook also notes that there are increasing signs that credit conditions are tightening broadly. This could be a cause for concern, as it could lead to stress that could spill over and threaten macroeconomic stability. These are without a doubt very scary predictions, but what can you really do on your part to prepare? If the recession hits in the second half of 2023, that leaves you almost half a year to prepare. So what to do? Here are several ways to prepare for a recession. Build up an emergency fund. Having a solid emergency fund can provide a financial cushion during a recession, allowing you to cover your expenses without having to rely on credit or sell investments at a loss. Aim to save at least 3 to 6 months worth of living expenses in a savings account so that you are prepared for unexpected events such as job loss or a sudden illness. Pay off high-interest debt, such as credit card balances, can become increasingly burdensome during a recession. By paying off these debts before a recession hits, you can reduce your overall financial burden and increase your flexibility to weather the economic turndown. By paying off high-interest debt, you'll have more disposable income to put towards savings and increase your flexibility to weather the economic downturn. Be mindful of your spending. During a recession, it's important to be mindful of your spending and avoid taking on unnecessary expenses. Prioritize your spending on essential items and services such as food, housing, and healthcare, and cut back on non-essential expenses such as dining out and travel. By being mindful in your spending, you can ensure that you have enough money to cover essentials and build up your savings. A side hustle can provide an additional source of income during recession, helping to increase your financial security and reduce your dependence on a single source of income. You can explore different options like starting an online business, freelancing, or renting out a spare room on Airbnb. These can provide an additional source of income that can help you to cover your expenses and build up your savings. It's important to remember that no one can predict with 100% accuracy when and how severe a recession will be, but planning ahead and being proactive can help you to minimize the negative impact on your financial situation. So, while the JP Morgan predictions may be daunting, you still have to hope for the best and prepare in advance. Those analysts can be right or wrong, but if you implement some financial practices into your life, you'll win either way. Also, I would like to mention that the information in this video is not financial advice, and you should contact professionals before making any financial decisions. Thank you for watching. Bye.